Welcome to Money Flow IQs, where smart money meets smart learning.
We've got a stack of sources here, all pointing towards, well, a really fundamental truth about the stock market, something often missed.
Yeah, it's true. We're here to cut through some of that noise.
Because if you're like most people, you probably see the stock market as this crazy place, numbers flashing, prices bouncing.
Up and down, yeah. People think it's just gambling, right?
Yeah.
Or pure luck.
Exactly. And that view, our sources say that's the biggest roadblock to actually building wealth.
It is. It's this common misconception, and honestly, the media kind of feeds it, focusing on every tiny tick up or down, like it's a casino.
Uh-huh. So our mission today, really, is to explore how the truly great investors think differently. They shift focus away from just the price
Which is jumping all over the place.
to the underlying value,
Yeah.
the solid, enduring value of the business.
And the goal at the end of the day, it's simple conceptually. Buy when that price tag is way below what the thing is actually worth.
Simple to say, maybe harder to do, but it all starts with one core idea, doesn't it?
Absolutely critical. When you buy a stock, you are not just buying a ticker symbol that you hope goes up. You are buying a piece of an actual real-world business.
You become a part owner. I saw this funny, sarcastic LinkedIn profile mentioned in the research.
Yeah.
Someone listed themselves as partner in Tesla 2017 to today.
Yeah, meant as a joke.
But the joke's kind of on them because it's literally true, isn't it?
Yeah.
Legally, economically, you are a partner. You own a slice of the assets, the cash flow.
The future profits, hopefully. And thinking like an owner, that changes everything.
How so?
Well, think about it. If you owned, say, a local coffee shop outright, would you freak out and sell it because someone walked in one morning and offered you 5% less than you think it's worth?
No, probably not. I'd look at how many coffees we sold yesterday, right?
Yeah.
Are people still coming in?
Exactly. You'd look at the business fundamentals, sales, profits. Is it healthy? That's the owner mentality.
Okay, so let's unpack that.
Mhm.
Applying the owner mentality means avoiding the big emotional trap.
The panic trap.
You see people glued to the screen, the price dips 10%, 20%, and they hit the sell button. They assume the business is collapsing.
Which is usually the wrong assumption. Value investing means taking a breath. You step back, you ask, okay, did the business fundamentally change overnight? Are its long-term prospects really worse?
You have to do the work to figure out, what is this thing actually worth, independent of today's price tag?
Right. It's often compared to shopping, which is a decent starting point.
You're looking for a deal.
Yeah, but not just anything cheap. You don't want a terrible business just because it's marked down, and you don't want to overpay for a great one either.
So you want a good business
A quality business.
that happens to be priced cheaply right now, like finding, I don't know, a really well-made coat on sale after winter.
That's the idea. But here's the crucial difference, and this trips people up. The stock market isn't like a grocery store.
How do you mean?
Well, at the store, milk is $3.99. The price is set. It's stable day to day. The stock market, it's an auction, a giant global auction.
And auctions can get pretty wild.
Yeah. Extremely wild. They're driven by emotion, right? Fear, panic, greed. Sometimes, as one source put it, just by someone having like too much coffee that morning.
Huh. So the price swings aren't always rational.
Often they aren't, especially in the short term. They get disconnected from the underlying reality of the business.
There's a great metaphor for this. The house ticker.
Yeah, explain that.
Okay, so imagine your house. Let's say it's realistically worth $400,000 based on comps, condition, schools, all that.
Okay, solid value.
Now imagine some crazy auctioneer stands on your lawn with a giant ticker, flashing prices. 1 minute it says $500,000. An hour later, $300,000. Then back to $450,000.
Has the house changed? Did the bricks crumble and rebuild themselves in an hour? Did the school district suddenly get better or worse?
Of course not. It's the same house. The auction noise is just nuts.
Exactly. And the only reason we think house values are stable is because we don't have that ticker flashing prices 204.7.
Right. Stocks have that constant ticker, so the price seems volatile.
The price is volatile because the auction is always running, but the underlying value of the business, like the value of the house, is much, much steadier. The noise is the price, not the value.
Okay, that makes sense. And this difference between the noisy price and the steady value really highlights the difference between the short run and the long run.
Critically important distinction. In the short term, that auction, it can be completely irrational.
Look at a company like NVIDIA, for example. Huge player in AI, right? Leading its field.
Definitely.
Yet over less than a year, we saw its stock price go from, around $150 down to $86, then zoom back up towards $190. Wild swings.
Okay, so ask yourself the owner's question. Did NVIDIA's actual business, its ability to make chips and generate profit, really fall by nearly half and then double again in just a few months?
No way. Their revenues, their profits, they were actually climbing pretty steadily through that whole period.
Right, so those massive price swings, that was the auction noise. That was short-term sentiment, fear, greed, whatever. It wasn't reflecting the underlying business reality at that moment.
And that kind of short-term wiggle is where a lot of Wall Street gets it wrong, isn't it? This smart money fallacy.
Yeah, the quote-unquote smart money is often thinking in weeks, months, maybe quarters. They're trading.
The research said it's like kids trading Pokemon cards, just swapping pieces of paper based on popularity.
It can feel like that sometimes. Whereas value investors, people focused on ownership, they have to think in years, multiple years, even decades.
Which brings us to that core maxim, maybe the most famous one in value investing.
The voting machine versus the weighing machine.
Explain that. In the short run,
In the short run, the stock market acts like a voting machine.
it's a popularity contest. Who's hot right now? Who's got the buzz?
Exactly. It's hype, it's emotion, it's which company is the coolest kid in school this quarter. That's what can drive a stock price up 20% on basically no news, pure sentiment.
Okay, that's the voting.
Yeah.
But in the long run,
In the long run, the market becomes a weighing machine.
weighing what?
Weighing the actual substance, the reality, the cold, hard facts of the business, the profits it generates, the cash flow it produces, the growth in its intrinsic value.
So eventually, the actual weight of the business, its financial performance, determines the price.
It has to. If a company consistently grows its earnings and cash flow over years, the stock price, eventually, must reflect that underlying growth. The weighing machine catches up to reality.
That sounds logical, but sticking with it when the votes are going against you must take some nerve.
Oh, absolutely. Think about Microsoft back around, say, 2011, 2012.
What was the story then?
The story, the popular vote, was that Microsoft was dead. Old news, irrelevant. This prominent tech CEO even publicly called them a dead company. All the hype was around mobile, cloud, things Microsoft was supposedly missing.
Right, the voting machine was saying sell.
Loudly, but what was the weighing machine showing? If you looked at the actual numbers,
What were they?
revenue was still growing steadily, like 7-8% a year. Profits, growing even faster, 10-11% a year. The business was fundamentally healthy and growing.
So the smart money trading on the negative headlines.
They missed it. They missed the quiet compounding happening underneath. Eventually, the fundamentals, the weight, won out, and those who held on saw massive gains.
And then there's the flip side, where the voting machine gets it spectacularly wrong, Cisco system.
Oh, Cisco. Classic.com bubble story. Back in 2000, the vote was overwhelmingly positive. It hit $82 a share. People thought it was going to take over the world.
It famously never hit that price again.
Never again. The voting machine was completely out of touch with sustainable reality. But here's the part people forget: the weighing machine.
What about it?
Since that peak in 2000, Cisco's actual business, revenue is up something like 4 times. Profits are up maybe 5 times. It's a much, much bigger and more profitable company now.
Wow, so the business grew massively.
Massively. And guess what? If you ignore that crazy peak, the stock price over the long haul since the crash has pretty much tracked that underlying profit growth. The weighing machine eventually reflected the 5-fold increase in profits. It just took decades.
And the ultimate cautionary tale of the voting machine gone wild. Enron.
Right. The vote said, genius, innovative, unstoppable. Everyone loved it.
Until the truth came out.
Until the truth came out and the weighing machine finally registered. And what did it weigh?
0.
0. Because the underlying substance wasn't there. The votes were based on lies. Reality always wins.
Okay, so if the long game is about the weighing machine, then the investor's key skill, after figuring out the value, is
Discipline, patience, the power of waiting. And this comes after you've done the hard work of analyzing the business and estimating its value.
you have to mention Warren Buffett here. His Coca-Cola investment in the late 80s is legendary.
It is. He paid what looked like a really high price at the time, maybe 30 times profit. People thought he was crazy.
Why did he do it?
Because he wasn't looking at next quarter's earnings. He saw the global machine, as the research calls it, the incredible brand, the distribution network, the power to raise prices over time. He calculated the future value.
And then he just held it.
Pretty much. His incredible returns didn't come from darting in and out. They came from sitting tight for decades, letting the business compound its value and letting the weighing machine do its work.
It reminds me of that Charlie Munger quote.
Ah, yes. Munger nailed it. The big money is not in the buying or selling.
But in the waiting.
Exactly. That inactivity, that sitting still, it's not passive. It's a deliberate strategy. It's the hardest part for many people.
Because once you've done the homework, studied the business, projected its future cash flows, calculated its intrinsic value, your main job is what?
Your main job is to let time work its magic. Let the business grow. Let the value compound. You have to fight that constant itch to do something.
That itch to act is what kills returns, isn't it? Constantly tinkering, reacting to every news headline, every price wiggle.
It absolutely tanks performance for most people. You did the work upfront to buy right. Now let it play out.
And while you're waiting, you keep your eye on the business fundamentals.
Absolutely. Is the company still doing what great companies do? Growing revenue, generating more free cash flow, improving profits, keeping debt manageable, strengthening the balance sheet.
That focus on cash flow and manageable debt seems key.
It's crucial. That's what allows a company to survive the inevitable market storms, the irrational panics. If the business can easily pay its bills and fund its growth, it'll be around long enough for the weighing machine to recognize its true worth.
Okay, let's try and crystallize this. We've talked about mindset, analogies, history. What's the actual framework, the principles that keep disciplined investors grounded?
Yeah, the sources outlined about 5 core tenets. Think of them as guardrails against emotion.
Okay, number 1.
Tenet 1, we are investors, not speculators. Big difference.
Investors focus on the business quality and its future earnings.
Speculators just bet on which way the price ticker will move next. Pure gamble.
Okay, tenet 2.
Every investment is worth the present value of all its future cash flows.
Okay, that sounds a bit academic. Break it down.
It just means you're trying to figure out what all the cash the business is going to generate in the future is worth if you received it today. A dollar owned 10 years from now isn't worth a full dollar today, right? Because of inflation and because you could have invested that dollar elsewhere.
Right, you discount it back.
Exactly. You discount all those future potential profits back to today's value. And this also shows that growth investing isn't really separate. It's just value investing where you plug in higher expected growth rates into those future cash flow projections. Same basic math, same discipline.
Got it. Tenet 3.
If we don't understand it, we don't buy it. Stick to your circle of competence.
That sounds simple, but why is it so hard for people? FOMO.
Fear of missing out, exactly. The voting machine is shouting about some hot new thing, crypto, biotech, complex derivatives. Everyone seems to be making money.
And you feel like you have to jump in, even if you don't really get it.
Right. But if you can't explain what the business does and how it makes money simply, you shouldn't own it, period. Sticking to what you understand prevents so many dumb mistakes.
Makes sense. Tenet 4.
We've covered this one well. Short run, it's a voting machine. Long run, it's a weighing machine. Keep that time scale in mind, always.
Okay. And the last one? Tenet 5.
This is the safety net. Even a great company, a great story can be a terrible investment if you pay too high a price.
You can overpay for quality.
Absolutely. You always need a defensive mindset, which leads directly to the margin of safety.
Explain that term. Margin of safety.
It's simply the gap between what you calculate the business is really worth its intrinsic value and the price you actually pay for the stock.
So if you think the business value is, say, $1 per share.
You want to buy it for maybe 60 cents or 70 cents, that
Yeah.
30 or 40 cents difference, that's your margin of safety.
What does it protect you from?
It protects you from being wrong. Maybe your calculations were a bit optimistic. Maybe the business hits an unexpected rough patch. Maybe the market just stays irrational longer than you thought. That buffer protects your capital. It ensures you're buying value cheaply, not just fairly.
You're not trying to pay $1 for $1 worth of value. You want $1 worth of value for, like, 60 cents.
That's the goal. That's where the real returns come from, minimizing downside risk. You avoid acting like a speculator paying $2 for $1 of hope.
So bringing this all together for you listening, what's the takeaway? It means ignoring the noise, right? Start checking the price constantly.
Focus on the business. Understand what you own. Calculate its approximate value. That's your anchor.
And learning this way of thinking now is incredibly valuable.
Massively advantageous because market downturns, crashes, big drops in price, they will happen. They always have. They always will.
And the informed investor, the one focused on value.
Sees that crash not as a disaster, but as an opportunity. It's a sale. High-quality businesses suddenly available at bargain prices because the voting machine is panicking.
While your neighbor, who only watches the price, is freaking out, selling low.
Selling their ownership stake for pennies on the dollar. You, the disciplined investor, can be calm, confident, ready to buy more maybe. You see the temporary price drop for what it is noise.
You're prepared for that moment.
Which leads to maybe a final thought to chew on.
Go for it.
It's really, really easy to say you're a long-term investor when everything's going up. Everyone feels like a genius in a bull market.
Mm-hmm.
The real proof, the real test of whether you've internalized this comes when the market tanks. When prices are down 20%, 30%, 40%, can you stick to your guns then? Can you remember that the price swings are just the auction being crazy?
Well, the underlying value you calculated is likely far more stable.
Exactly. That gap between the volatile price and the steady value, that's where the opportunity lies. That's where long-term wealth is built. It's about doing it, not just saying it.
Subscribe for more smart money ideas every week.